All right, good evening, everyone. Welcome to our UC Riverside Alumni Homebuyer Workshop. My name is Jason Maida. Great to be with all of you this evening. I know you have a lot probably going on this week, and we appreciate you taking some time to spend a little bit of time with us just to learn a little bit about homeownership tonight. So this is one of our classes that we teach 4 times a year for the Alumni Association, and really excited that you guys could be a part of this. I know we have a lot of folks joining tonight's class. We had a pretty good little sign-up list. This class allows you to really understand more about some different tools and resources that are available to you as prospective home buyers. And this class is a very interactive session. So as I go through tonight's class, I encourage you to ask questions of us. You can use the chat feature or Q&A in the Zoom session, and I'll make sure that I kind of monitor both of those sessions or both of those windows. And then we're going to record tonight's class. So we'll share back out the recorded version. It'll be up on our YouTube channel tomorrow, so you can check that out. And all of the slides that we have and we're presenting tonight will be emailed back out to everybody that signed up for tonight's class. Okay, so we're excited to take you on this journey tonight. Again, my name is Jason Maida. I'll be your host this evening. And then my colleague, Ken Fleck, will be also helping me kind of manage some of the questions that are coming in from our audience. I work for an organization called American Pacific Mortgage. We are the 9th largest lender in the country. Where our home base is right here in Northern California, but we serve the entire country from here, including a lot of work we do in Southern California. And we really specialize in first-time home buyer programs. So you'll learn a little bit about that tonight. For those of you that are in California, which I think is most of us in class tonight, there's a program that we're doing a lot of work on in different campaigns with the California Dream for All program. So we'll talk about that tonight. Certainly be willing to take some questions from you on that. And we'll dive into that as one of our talking points later on in the class around first-time home buyer programs. These are our talking points for this evening. We'll spend some time talking about the housing market, what's happened to interest rates this week. We'll go through a rent versus buying calculator just so you can understand like what's the elements that make up what I can possibly achieve with home ownership. We'll talk about credit and how we can maybe build up our credit and some tips and resources for you. We'll also look at different loan programs that are available to you as homeowners. And then we'll talk a little bit about savings for home ownership, because savings can be one of those little challenging things for some of our buyers that are just trying to figure out how I get access to home ownership. And then I'll kind of allow us to then dovetail into like different first-time buyer programs that are available to us. And then one of the more important elements of tonight's class is to talk about the buying process. Because after you leave a class like this, we got to figure out like, where do I go from here? So I want to take you through the buying process, a really simple 6 steps of home buying, so you can get a better sense of like, hey, if I want to build a plan towards home ownership and achieve that financial goal at some point in time, where do I go after tonight's class? Okay. So that's what we're going to plan on doing. Again, I encourage you to ask questions in tonight's class. For those of you that tuned in late, we are recording tonight's class and sharing back all of the information from our slideshow. All right. Well, let's talk a little bit about what does buying mean, or does it really make sense for me? I guess more importantly for us as prospective homeowners, when you're considering thinking about home buying, you really need to consider some of the really important aspects of affordability. This hopefully will be an opportunity to create better affordability for you. Even though I do realize we're at higher priced homes and interest rates aren't great, but this has the ability to create stability in your housing budget, right? Because when you're a homeowner, you don't have to worry about your rent increasing every year when you decide to renew your lease. A lot of our buyers that are purchasing in today's market, I'm having the conversations around refinancing their homes at some point in time. So that's certainly something we'll take a look at as well. And this is an asset that should grow in equity over time. So if I buy my home for $600,000 and in 10 years it's worth $750,000, well, that's wealth growth, right? And when we look at how much our home is worth versus what the house balance is or our mortgage balance, that difference is called home equity. Now, for many of us that are current homeowners, it's probably our number one asset aside from maybe our retirement accounts and stuff like that. So really powerful tool in home ownership to be able to create potential generational wealth for families. And there are some tax deductibility benefits. I was just talking to one of our new homeowners that's buying this month and, not realizing the power of tax deductibility of interest for certain tax brackets, and maybe other tax benefits that come along when you decide to make maybe energy efficient upgrades to your house. So I really encourage our classes to kind of think more beyond home ownership because it's not simply looking at, hey, I'm paying 2,500 in rent, so I'll probably pay 2,500 in mortgage. We want to really factor in all the really important affordability aspects that make up home ownership. To help kind of frame that up for you, I thought I would take you guys through one of our tools that it's available to you. It's called our rent versus buying calculator. What this can do for you is just really help you understand what it's going to take, when we think about budget, but when you factor in like what price of home you're going to buy, what you're currently renting at, and what your new mortgage is going to be, like what are the upsides of home ownership? And so this is a calculator that I would encourage you guys to check out. We also kind of walk you through this during our consultative process with you when you decide to build your home buying plan. Beyond this rent versus buying calculator, there's other tools that you can utilize, whether that's trying to figure out just basic payments or affordability, whatever the case may be. I do want to walk our class through this exercise just really quick because I feel like it's a great launch pad into further discussions tonight. So let's assume we bought a house for $650,000, right? And you're going to learn tonight that the minimum down payment is 3% of your purchase price. That means I would finance $630,500. We would plug in an interest rate, which interest rates are up a little bit today. So we'll talk more about that. But let's say it's 6.25%. We have a 30-year fixed mortgage, which is going to be mostly the case for our first-time buyers, assuming that we bought, let's say, in March of this year or beyond. Mortgage insurance that we'll also spend some time talking about tonight, which comes into play when I put less than 20% down to buy my house. And then we also want to include things like homeowners insurance and taxes. And if I decide to buy maybe a condo or a townhouse, there might be HOA expenses associated with that. And then we put in our tax bracket for where I'm currently at. So that would obviously vary based upon what your income looks like. The cost of maintaining my house. Now, eventually, because this asset may get to a certain level of value that I might want to sell at some point, right? So there's going to be some selling costs down the road, and then of course what my home appreciation rate looks like. Now that's what the homeownership side is, and then on the rental side is what am I paying in rent? In this scenario, we just put $3,000. Someone that's paying 1.2% of their rental costs in insurance, so basically renter's insurance, and then assuming that your rent goes up like 2% a year, which is probably pretty reasonable. So what we do is we put that into this calculator, and then it kind of tells us back, okay, what's the break-even point? So if I decide to purchase a home at some point, how long is it going to take for me to break even in my investment? And right now you can see it's about 3 years here based upon that equity appreciation, paying down my mortgage, tax benefits. I'm going to break even in 3 years. My general rule of thumb is I would want to break even in 4 years or less. So obviously we accomplished that goal for someone that is paying $3,000 a month in rent and deciding to purchase for $650. Now, where it gets a little bit more exciting is when we start pushing that timeline further out. So let's say I'm at 7 years of ownership, right? Well, guess what? At 7 years, I now have $73,000 in buy gain versus me continuing to pay rent on a monthly basis and more than likely probably paying somebody else's mortgage. So that's where it gets a little bit more exciting. And then, if we were in a home for say 10 years, let's just change our marker to 10 years. We'll move this little dial up here. Well, now we have a little bit more time in our home. Markets hopefully improved a little bit more. Now we're at $144,000 in gain opportunity of owning versus renting. Now, it doesn't always look that favorable in the math for some clients, but certainly there is opportunities for clients to really improve their financial health, if you will, just the equity growth that they have in home ownership. That I know is kind of tough to realize for renters to say, hey, gosh, how do I really transition from that current situation I'm in of rent and get into home ownership? Well, classes like this can help you really kind of help you realize, I guess, that it is truly an opportunity out there for you. So that's our rent versus buying calculator. I would encourage you to check it out. I think it's a great way of kind of just teeing up home ownership and kind of really having a better understanding of what the real value proposition is in home ownership. Now, your entry point to home ownership and when you decide to get into the market really might depend on where interest rates are at, but also probably where the housing market's at. This is a snapshot at the Riverside housing market, which is fairly similar to many markets in Southern California. Now, the price point looks different in LA County than Riverside County or San Bernardino or Orange County, whatever county you're looking at. But I think the trend is about the same. We're seeing kind of a little bit of a downward pressure on prices, not huge. We expect that, prices will probably flatten a little bit this year, maybe tick up just a little bit. You'll see some of our 26 projections in just a minute. But what we're finding a bit interesting is homes are staying on the market a little bit longer. Some of that's just part of the seasonality in the markets. Some of it's just kind of what's happening in the world today. But ultimately, the market is starting to see inventory stack up a little bit, but we do still need more supply for buyers. As we look into 2026 and how we're forecasting this year, we're probably going to see the housing market do a bit of a reset because interest rates will start to ease a little bit, which creates better affordability for our buyers as well as some of our existing homeowners that purchase at higher interest rate levels. The price growth is expected to be modest, so we may see a little bit of uptick in some markets, but we won't see big gains in valuations. Some markets might even dip a little bit. We're already seeing that in different parts of the country. Some of the inventory or supply that we're looking for is starting to improve a little bit. Builders are still building, but they are building more so for situations where, that's very tight timelines. So they're building, 2 and 3 months out. They're not building 4 and 6 months out down the road. So they really want to make sure there's going to be buyers to purchase their homes, right? Opportunities in this market when we see things like maybe higher levels of interest rate can present opportunities for our buyers if they're kind of financially fit and ready to go. And I do think classes like this hopefully help kind of feel like you're a little bit more prepared to take on homeownership whenever that time is right. Now, looking a little bit further at the California housing market forecast, here's the last few years of the housing market in California, and this is kind of what we're forecasting. So we've already kind of spoke to this, a little bit of an uptick in price, about 2% increase in price. You can see the median home price change up 3.6%. That does vary by market. Affordability improving by about 1%. Probably doesn't feel like it for some of us, but a little bit better improvement in affordability, all attributed to where we're seeing interest rates hopefully go this year. Well, this week we haven't had the most favorable news in interest rates. Obviously, we have a few things going on in the world right now with the conflict in the Middle East and, kind of what that's doing to oil prices and really the economic or financial markets. On Monday we saw the Dow Jones lose over 1,000 points. We saw another loss on Tuesday, Wednesday, kind of a reversal, a little bit of a positive gains in the Dow Jones, and now we lost again in the Dow today. So interest rates are obviously feeling the effect of what's going on overseas right now. We were on a nice little run last Friday. Interest rates were on their way to going below 6%, and then we got a nice reversal of course here. So I do think things will eventually kind of settle out in the interest rate landscape. Our projections are for interest rates to potentially go beneath 6% this year, but a lot of where interest rates go will be predicated on, what obviously happens globally with what we're dealing with right now. Also with what's going on in our U.S. economy. The Federal Reserve is watching what's happening with the labor markets. We have a big employment report coming out tomorrow that could swing the markets one way or the other. But they're also watching inflation, and the inflation goal for the Federal Reserve is 2%. And so we're still about 2.3, 2.4. We're not quite at the goal levels that the Federal Reserve is looking for. But hopefully, as we get closer to those benchmarks, that we'll start to see maybe the Federal Reserve act on rate cuts. I don't think this next meeting that we see from the Federal Reserve that we'll see a rate cut. It's like a 0% chance we're going to see a rate cut unless something wild happens in like the payroll numbers that come out tomorrow. Now, interest rates for buyers are not the same for everyone. I think that's important to understand because even though maybe your colleague received this interest rate or your family or your neighbor got this interest rates depend on the market because the market changes every day. Just like I mentioned, interest rates were a lot lower last Friday than they are today. The characteristics of the interest rate, like credit score and your eligibility for a product, what your down payment looks like, how much you finance. You can have the option to pay down points on your loan, which are basically paying more expenses out of pocket in order to lower your interest rate. That can also change what your interest rate looks like. And then the term of your loan can also change your interest rate. So if I generally shrink the term of my loan down from a traditional 30-year mortgage to say maybe a 15-year mortgage, that can also help bring down my interest rate. So we're going to figure out the best way to craft your financing solution. So when we get a chance to meet together for your one-on-one consultation, we're going to figure out what the best setup is for you with your options. Now, credit does play a role in eligibility for a product, the cost of your interest rate, even mortgage insurance when you decide to put less than 20% down to purchase your home. So every loan program does have a minimum credit score, and we've kind of highlighted some of those products on screen. For those of you that are in California, which, like I said earlier, is probably most of us, the CalHFA Housing Assistance Program has a minimum entry score of 640 for an FHA loan, 660 to 680 for a conventional loan. So it's just important to understand that we do have to hit a certain threshold of credit score to qualify in certain products. Generally, for most products, the lowest score we can go down to is about a 580 score. Now, we look at all three agencies reporting, which would be Experian, Equifax, and TransUnion, and we take the middle score of those three agencies. So if your highest score is 760, and let's say your middle score is 740, and your lowest score is 720, we're going to take 740 as the score that we use to help you qualify for your home financing. If you have a partner that's going to join your loan application, right? And let's say they have a middle score of 700. Well, your interest rate might change a little bit. The cost of mortgage insurance might look different. Probably won't change your product offering, but certainly mortgage insurance and interest rate may change. When you look at your credit report, and maybe you've had some challenges in the last 12 to 24 months, if you've had a negative item that appears in that span of time, it's probably going to be feeling the effects in your credit score. Now, as the further you get away from that element in your credit score, that late payment in October of 25, as I get further away from that late payment, I'm going to start to see some improvement in my credit score. So really, we're looking at the last 12 to 24 months. It's really going to be impacting that credit score. Now, those images of, say, a negative credit reporting will last longer on the credit report. But when we're speaking to like the effects of the credit score, it's usually in the most recent 12 to 24 months. So that same late payment will image on your credit report for 7 years, but probably not going to impact you for more than 12 to 24 months on your score. The further you get away from that negative item, the more kind of improvement I'll start to see in my credit reporting. Now, there's three different models to credit scoring. There's auto financing, mortgage, of course, which we're talking about tonight, and there's also a credit card. And for most of us that are doing your general credit monitoring, whether that's through Credit Karma or maybe American Express sends you your credit score, they're going to be using the credit card model. So it's not necessarily going to be accurate to what we see on the mortgage side of things, because there's different elements that go into a mortgage credit risk score than what you would see in a credit card score. Here's what we look at on the mortgage score. And we're going to kind of take you through kind of these different areas and have a quick discussion around this, which is, the first thing is length of credit, which is how long I've had credit open. Longer, more mature my credit file is, probably the better my credit score is going to be. The next component is in-use credit. So am I trying to get access to new credit by opening up new accounts? Do I have a creditor or creditors that are doing hard inquiries on my credit? Because hard inquiries can damage your credit. We only start with a soft credit check when it comes to our process for helping our clients, because a soft credit check can just allow us to get access and understand someone's credit without impacting it. And for our first-time buyers, especially, like when you meet with me for your consultation, you're probably not going to want to run out and buy a house this weekend, right? So it's more of a process of several months, maybe a couple of years before we decide to really get active with home buying. So we want to give you all the tools and resources to home buying, but not impact your credit score. And then as we continue on, amount owed is going to be really around revolving credit. So we're looking at what our revolving balances are versus credit limits. Ideally, you want those balances to be 10% or less of your credit limits. We call that credit utilization. If you're a little bit higher, let's say you're at 70 or 80% utilization, our first action item would be to try to get to 50%. That's probably a good way of kind of a starting point, and then work our way to 30% and then optimal level. So if you're trying to get to an 800 credit score, you probably want to be at 10% utilization or better. Here's a tip I want to give you to manage your credit card debt. And it's really simple, but if you look at one of your credit card statements, there's going to be a statement or billing cycle, closing date, whatever they want to call it. That ultimately is the credit activity for the preceding 30 days. So my tip for our class here is if you can pay down your account before that date closes out for the statement, or pay it off ideally, then you're going to get a lower balance that reports out to the credit agencies at the end of that cycle date. And with that lower utilization, you're probably going to also improve your credit score, especially as you're getting ready to apply for things like mortgages or any other big purchases. Next thing is pretty self-explanatory, which is going to be payment history. How have I paid all my bills? Do I have any late payments? If I have late payments, those are going to be rated as 30-day lates, 60-day lates, and then 90 plus day delinquencies. The more days overdue that I am on the credit bureau, the bigger impact I'm going to have to my credit score, and especially in the most recent 12 to 24 months. Now, kind of segueing into our next topic from credit is going to be student loans. And student loans are going to be one of those things that we have to kind of explore a little bit. And I always like to share with our classes that student loans shouldn't be a barrier to home ownership for you. We just got to have to talk through them. So whether you're on an income-based repayment plan, like you see on the left-hand slide, which is, looking at a situation where I'm paying maybe $250 per month on $75,000 in student loan debt, that is qualifiable. Or if I'm not in active repayment, I'm in forbearance or I'm back in school, we can still work through those things, but there's kind of like guidelines that we have to adhere to in financing. So in that scenario where I am in forbearance or back in school, if I do have $75,000 in debt, if I'm doing an FHA loan, I have to take 0.5% of those balances as the monthly payment. So that would be $375. Or if I'm doing a conventional loan, it would be 1% of the balances as my monthly payment. On income-based repayment plans, pretty simple. Those are like savings plans. So if I'm on a $250 per month savings plan, then in financing, I can use that payment right away. So I think where we get into challenges as I'm working with buyers across the country, it's more so around student loans that really aren't in active repayment. Because if you're not in active repayment, the student loans report is zero payments. And so that really kind of like shows us that there's no payments being made. So then if we're applying for financing, we have to overlay with one of those calculations, either for the FHA loan or the conventional loan. The reason why we do that is because there's guidelines that we have to adhere to each of the products that you see on screen. Before I get into those products, I do want to take this question that came in from the audience, which is, are paying off student loans more favorable, or is that favorable? It's not really going to move the needle one way or another. I mean, from a credit score perspective, I guess I should say, of course, you get rid of debt, it's going to lower the expenses that you have going on. And we're going to talk more about expenses in home ownership that we calculate in. We call that debt to income ratio. So if you're trying to lift credit score by paying student loans, probably not. But if you're trying to lower debt outgo, that could be favorable for sure. So these are some of the programs that we offer, and I would say 4 of the 5 are more the typical ones, especially for our first-time buyers. So for a conventional loan, that is centered around Fannie Mae and Freddie Mac guidelines. You guys probably hear them talked about in the news a little bit. That has a minimum down payment of 3% up to a loan amount of, it's a little bit higher than this 806 figure. It's about 826 or 832. We call that a conforming loan limit. That limit gets adjusted every year based upon the cost of living. And for these conventional loan products, the minimum credit score used to be a 620 credit score, but now they do an overall credit risk assessment where they're looking at, credit scores, but they're more so looking at assets, pay history, time on the job, all that stuff. So it's more kind of a more of a all-inclusive look at your overall financial profile. Now, if you're in LA County or Orange County, and those are all considered high cost of living areas, we can go to a higher limit, closer to 1.2 million in loan amount. But when we jump that loan amount above the conforming limit, it changes the minimum down payment from 3% to 5%. Next product is the FHA loan. That stands for the Federal Housing Administration. That is not just a first-time buyer program. It can be used for first-time buyers or even second-time buyers. It is a government-insured program, just like the USDA program just below that. Both of those programs, since they are government-insured, have had some changes as it relates to residency. You cannot be a non-permanent resident to access those products. You do have to be a permanent resident. FHA will give us a little bit more flexibility in credit score requirements, and the loan amount will vary based upon the county or location that I'm buying in. USDA just below that is for more rural purchases. So if I'm buying in more of a kind of a more remote area, I can do that with a zero down payment option. but it does come with it maximum loan amounts as well as income limits by that particular county that you're going to purchase in. And then the jumbo loan is going to be designed for clients that need to be purchasing a little bit more, above maybe the conforming or high balance limits. It's not typical for our first-time home buyers because it does have higher down payment and higher credit score requirements. And then finally, for our veterans that have eligibility for the VA home loan, the VA loan has 100% financing, lower credit score requirements, a little bit more flexibility and eligibility. And there's currently really no maximum loan amount for the veteran, but we really obviously want to help support and encourage home ownership for our veterans. And so that product is tailored to be able to add more flexibility for eligibility for the veteran. Now, for programs like conventional loans and FHA loans, there is mortgage insurance that comes into play for a conventional loan when I put less than 20% down. And then for an FHA loan, regardless of down payment, you will have mortgage insurance. So I want to explain to you both PMI and then MIP when it comes to home purchasing. So let's talk about PMI first. On the conventional side, PMI stands for private mortgage insurance, and it essentially insures the lender against default by the buyer. So if I put less than 20% down, I'm going to have mortgage insurance. And then that mortgage insurance is calculated based upon my down payment, my credit score, and then how much I decide to finance. Okay. Now, one of the benefits of using conventional loan PMI is that when I reach 2 years in my home and I have 20 to 22% equity, I can apply to have my mortgage insurance canceled. Okay. One of the misconceptions in the marketplace is that mortgage insurance is going to be super duper expensive, especially on a conventional loan, which honestly really isn't the case, especially if I'm a higher credit score customer. Good example is shown below here. If I finance $500,000 and I have, let's say, a 740 credit score and I'm putting 3% down, well, my mortgage insurance is about $154 a month. So if you've been starting your home search on, Zillow or Redfin or using some of their calculators, they might not be necessarily calibrated to what the actual premium is going to be. They usually inflate those a little bit. Now, on the other side of the equation is going to be the FHA loan, which is, again, a government insured loan. It's a little bit more of a one size fits all when it comes to mortgage insurance, because whether I'm a 640 credit score or I'm a 700 credit score customer, I'm going to have the same rate of mortgage insurance. Now, that rate is 0.55% of the loan amount for my monthly costs. And then there's upfront mortgage insurance, which is 1.75% of my loan amount. With FHA, a little bit different than conventional PMI, there's no cancellation option. So really, we're using FHA as our entry point to home ownership as our clients maybe improve credit, have more equity in the home. Then we're trying to refinance from FHA into more of a conventional product. Here's an example of the payment scenario with an FHA loan. So we have the same loan amount. Upfront mortgage insurance gets added into the total amount financed, which is $87.50. And then, of course, we have the monthly cost. So I get the question often is, well, Jason, what should we do? I'm an FHA loan looks like it maybe might be more favorable for us, but I really want to get towards a conventional loan. And so, we're going to figure out what the right design is for you for financing, because our FHA clients are probably going to be more in the 660 to lower range, maybe 680. Where it makes more sense to go with FHA versus a conventional loan. But more than likely, if our clients are 700 plus, we're probably looking at it more of a conventional product. But we obviously want to evaluate the different expense structures and, of course, interest rate offerings that are available to you as home buyers. As we take a look at those options and evaluate your eligibility, we also take a look at income for qualifying. So what I like to do in these classes at this point is just dive really quickly into different income scenarios for you. I do want to pass along kind of some documentation on some of the things that we'll ask for as you decide to start this process with us. Pretty simple items that you can see on screen. As it relates to different income scenarios, I thought I would share with you a couple different thoughts around that. When we verify income in financing, we generally have to verify the last 2 years of income generated, or we can use schooling to support that 2-year requirement. So we have to do a look back of 2 years. I might have been on the job for, let's say, a year right now, and I was at UCR for the preceding 4 years. That can help fulfill my 2-year requirement. Okay, so I don't necessarily have to be on the job for 2 years. We also have scenarios where clients are getting ready to start a new job, right? And they have an offer letter from a job, but they really want to purchase this home right away. We see those a lot when clients are like relocating to a different market. As long as we have a fully executed offer letter, we can use that for qualifying. Okay, so that's just something to kind of keep in mind. When we have situations where clients work in dual employment roles, so we see this somewhat in the healthcare industry. So we might have a client that works at multiple care facilities. Well, if we want to count both sources or streams of income, then we have to show that they've been working at both locations simultaneously for the last 2 years. If I'm self-employed, I do have to show that I have 2 years of tax filings, consistent tax filings. Because when we look at self-employed individuals, independent contractors, what have you, we do have to average the net income from those tax returns for the last 2 years. Now, other borrowers, it's always gross income, but for self-employed individuals, we take a look at net income. All right. Last thing I want to share with you, two things actually I want to share with you. One is variable compensation. So if you're in a position right now where you get bonuses or commissions and stuff like that, that's a scenario where in order to count those last couple years of commissions, I have to show that I've been on my job 2 years in order to use that source of income. Overtime would also be an example of that too. So if I'm on an hourly wage of $46 an hour, but I make time and a half and I work a night shift or whatever the case may be, in order to count that like variable piece of my compensation, I have to show that I've been on the job for 2 years. And then finally, last thing I want to share, because a lot of our clients will drive for Uber or Lyft on the weekends just to make some extra money, maybe to save up for home ownership. In order to count that additional source of income, then I have to show that I've been on both jobs simultaneously for the last 2 years. And then finally, as we move away from income, and then we're going to talk about debt to income ratio, I do get some questions around additional sources of income, like let's say my partner contributes to the household, but not going to be part of the application, or I rent out a room, that kind of stuff. We can't count room rentals into the equation because that's probably not going to carry over to the new place that you buy. And then if you have a partner that's contributing to the household, we can't count their income into qualifying unless they're going to be part of the loan application. All right. Okay, I know I'm giving you a lot of concepts here, but please feel free to drop a question in the chat if you do want me to kind of elaborate on something, or just obviously have a question that I can answer in tonight's class. I do want to talk to you a little bit about expenses versus income. We call that debt to income ratio. What we are looking at is your today expenses like credit cards, car loans, personal loans, student loans, all that stuff that appears on your credit report. And then we put in the projected housing payments that you're going to have. So, the principal and interest of my loan, the taxes that I'm going to pay, homeowners insurance. Maybe I'm putting less than 20% down and I'm paying mortgage insurance. All of those elements go into the mortgage payment. And so we take those expenses versus your pre-tax income, and we basically come up with a ratio. And we call that debt to income ratio. The highest that ratio can be is 45 to 50% of my pre-tax income going into those expenses. So that would be the highest it can be. But the comfort level that we see for most first-time buyers is around 33 to 36%. I got an example here on screen that you can see how that kind of calculation works. So you see that's the house payment of $2,500, $500 in other expenses, and this particular client makes $8,500 a month. So $3,000 versus the $8,500 would be a debt to income ratio of 35.3%. Okay. So that's what that would look like. And we're going to have discussions around debt to income ratio in your consultation, but it's really not as important as affordability, because affordability is really about where you see yourself feeling comfortable with a monthly expense in home ownership. And obviously we'll use tools like the buy versus rent calculator, but we really want to dive into like, what's the target payment? If I feel really good at $3,000 a month, that's what we're going to build your home buying plan around. Because even though you can qualify for a $4,000 mortgage payment, doesn't mean that's the smart buy. Maybe it needs to be around $3,000. Okay. All right. Now, the last component to kind of building a plan for home ownership is to talk about down payment. And down payment can be one of the bigger struggles for some of our clients. So I want to talk to you a little bit about some tools around first-time buyer programs in just a minute, but I do also want to pass along to you our just the checklist, if you will, of acceptable sources for down payment. Of course, cash accounts like checking and savings accounts can be used. We just can't use cash per se, where you're depositing cash into your account. Every asset that gets used in a real estate transaction has to be seasoned for at least 60 days. Okay. Retirement accounts can be used. 401ks, 403bs, those are all allowed. Investment accounts, brokerage accounts. I always encourage our clients, talk to your financial advisor before you access those assets, because we obviously don't want to create a tax liability or have you lose money in the market, whatever the case may be. But assets in general have to be at least 60 days. Now, you can also get gift funds from family members. Those do not require a seasoning period. Family members can send over money right away, and those don't have to be timelined out at all. Okay, so that's kind of a sense of the acceptable sources. Now, when we think about savings for home ownership, like I said, it can be one of the challenges that might push us out a little bit further for home ownership. I wanted to give you one tool, which is a savings plan, which is a really simple approach to saving up for home ownership. People think it's this kind of massive goal of home ownership that I have to save up 20%. Hopefully you've learned tonight that you don't have to have 20%. You can put as little as 3%. And in just a couple minutes, you're going to learn about more resources that can even close the gap on that amount. But if you're trying to save up for home ownership, here's how I would kind of think about it. If you're renting for, say, $2,000 a month in rent, right? That's the number today. But after doing an evaluation with us and you feel like you can get to a target affordable $3,500 per month mortgage payment, now we know that's an uptick in what you're currently paying, but you can afford it, right? What I would encourage our clients to do if we're lacking savings is let's start saving like I'm actually paying that $3,500 mortgage payment today. So on the first of the month, when I just paid my rent payment, I get in that habit of then taking another $1,500 and I transfer it straight to my savings account. I do that for 6 months, and now $9,000 has grown in that savings account. I do it for a year. Now $18,000 has grown in there, not including high yield savings accounts, which are out there for you. And it also creates a discipline of, hey, I'm getting used to paying $3,500 a month because I've been doing it in my savings plan. So when I transition to homeownership, it doesn't feel like such a big leap. We've had several clients that have done that and really been successful with that savings plan. I know it's really simple math, but really that shows you kind of the power of savings and kind of stacking up those dollars across several months of saving. Now, first-time buyer plans can get you there quicker as well, too. I know most of us are in California, so I do want to spend some time talking about the CalHFA assistance programs that are available to you. We're proud to be the leading provider of these assistance programs all across the markets in California. We are in the middle of a campaign for the Dream for All program right now. If you guys tuned in to, say, KTLA over the weekend, I know they had a little bit of a ad or a little bit of a piece, if you will, on the Dream for All program. Dream for All provides up to 20% of your sales price in assistance or $150,000, whichever is less. It is a lottery-based program that opened up last week, runs through March 16th at 5 p.m. We are still actively pre-approving clients for the Dream for All program. So if you're interested in that program, you can go to our website at mortgageeducate.com. We have a dedicated Dream for All page that shows you all the steps. And I think Ken from our team can pop that link into the chat here if you guys want. You guys can take a look at that. But it's a very unique product because at least one of the buyers involved in your application has to be a first generational buyer, meaning they have not owned a home in the last 7 years and their parents don't currently own a home in the US. Or if they've passed, they cannot not have owned a home at the time of their passing. But it does provide up to 20% of your sales price in assistance or $150,000. We are in the third year of funding of this program, and we've got a chance to help over 200 families with this program. It's a great, great product. Now, it is lottery based, so there's not necessarily a given that you will get it, right? So it is random selection. But there are other products that are available, like the My Home Assistance program provides up to 3% of your sales price in assistance for a conventional loan. If you decide to go the FHA path, FHA product with 3.5% assistance, both of those with the My Home. And what those products are a little bit different than Dream for All because it's a low interest rate loan that you get at 1%, but does not need to be paid back until you either sell the home or if you refinance in the future. And then we can also kind of add on other products like My Access, which provides closing cost assistance. And then outside of CalHFA, there's the Pathway program. And GSFA, which stands for Golden State Finance Authority. We use these products as kind of like options 2 or 3 if a client can't qualify for CalHFA, because CalHFA does tend to have lower interest rate options for first-time buyers, especially with lesser down payments, and there's just a much lesser cost in terms of the assistance that you're paying. If we were to look at a $500,000 purchase price of a home, and traditionally, if you were not doing something with the first-time buyer program, you would probably need about $27,000 to $30,000 out of pocket with the down payment requirement and what we call closing costs. which can be anywhere between 2 to 3% of your purchase price on average. So we would probably need $27,000 to $30,000 out of pocket. However, if you're using a first-time buyer program, now we can integrate things like My Home Assistance and now take that $15,000 that you thought you had to put out of pocket, get you some resources for that. So maybe you're only putting your closing costs out of pocket. Or if you have a larger need and you need closing cost assistance, we can bolt on things like the My Access or Zip Assistance program and maybe get up to $27,000 in assistance. So really cool ways of being able to make home ownership just a much more near-term goal versus thinking you have to save up for the next 7 years to get to 20% down, right? Now, there are eligibility requirements for these programs. There's credit score minimums for the FHA loan. Conventional loans, which the Dream for All loan is a conventional loan, has a minimum score of 680. There's also debt to income ratio requirements up to 45 to 50%. And then when we think about income for these programs, they are probably the most flexible agency when it comes to income limits because the traditional loan here with CalHFA goes up to 150% of the median income. And how we look at a first-time buyer is that it's someone that hasn't owned a home in the last 3 years. And this is eligible for all one-unit properties, so single-family homes, new construction, condos, townhouses. You can also do affordable housing projects. We call those BMR homes and manufactured homes. Here's the income limits for the program. This is specific for My Home Assistance, not for Dream for All. Just to give you an idea of the difference. So for Dream for All in LA County, I think we're right now at 168 versus for the My Home, it's 211. So we'll see the Dream for All program is, I think, right around 120% of the median income, where this is at 150% of median income. Okay, we're going to talk about the buying process, but I just want to see any questions from our audience on any of the first-time buyer resources. So we do get a lot of questions on that. And if you want to learn more about Dream for All specifically, we taught a class last Monday that is up on our YouTube channel, has a lot of views right now just because of the interest of that product. But we kind of do a deep dive, a live Q&A that we did on YouTube Live. So you might want to check that out. And there's a lot of helpful resources. Like I said, we'll put the get started information in the chat here. But if you have any questions, feel free to drop those in as well too. We're going to kind of round the finish line here of tonight's class. But before we get to the finish line, I do want to talk about where do we go from here, right? Hopefully you've gotten 1 or 2 takeaways from tonight's class. And those are things that you can use as a launch pad into really making a financial consideration of home ownership, right? And I think as you're thinking about home ownership, it's great to know where do you go from here. Well, I would love to be able to get connected with you guys for one of our free consultations that I do with our buyers through our partnerships. And that's a 30-minute virtual session that we put together for you. It is a free service that we do. It does have you complete an online application and upload some documents, but we take that financial information and we use it to go through like a coaching session in home ownership. After we finish that consultation session, then we issue a pre-approval for you. And that pre-approval just gives you a baseline of your eligibility. Now you can use that and start shopping for homes right away, or you can just say, hey, now I know what I qualify for. I'm going to still work on my financial goals and maybe buy next year, whatever the case may be. But ultimately, the pre-approval gives you that starting point. Now, once we're ready to start actively shopping, then we would move to step 2 in the buying process. And now we're starting to go from like looking online with Zillow or Redfin or whatever, site you're looking at. And then we kind of start working with a realtor. We would encourage you to work with a trusted realtor in your respective market. We do have preferred realtors that we work with. We're more than happy to make an introduction for you on whatever community you're considering. Now, that home search in step 2 might take the longest in this whole process because who knows, you might want to be in a certain school district, certain neighborhood. You might be waiting for this home to come on the market, whatever the case may be. But let's say you do identify the property you really love and you want to make an offer. Well, that realtor will help you make that offer to that home and they'll present that offer. Now, if that offer gets accepted, and sometimes it happens on the first try, sometimes it takes 2, 3, even 4 or 5 times to get an accepted offer. But let's say you do get that accepted offer, then you're going to move to the next step, which is step 3. So that's called entering escrow in California. That means you have a ratified or agreed upon contract with a seller. And that kind of starts kickstarting more the lending process. That day that your offer gets accepted, you're going to get a call from me saying, hey, congratulations, your offer is accepted. Now let's talk a little bit about next steps, what you should be looking forward to, and get you scheduled for your follow-up video session. Okay. Our team will be sending out you a checklist of items for you to start we'll fine tune everything for you. You're going to get disclosures sent to you, but that will come after your follow-up video session that you do with me, just to make sure all your financing is properly designed. Now, you also have action items like making a deposit for your house to secure the house. Usually that deposit is 1 to 2% of your purchase price, and it goes into an escrow holding account. That money will stay there because most contracts in California, you're going to have a contingency period that allows you to do your due diligence on the property. Things like get the inspections done, get the house appraised, get your loan approved. That usually will happen in somewhere between 7 to 17 days of the contract period. Okay. Again, your deposit is protected while you're in that time period. Now we'll kind of keep moving down the process here. Step 4 is kind of be more of the processing and the underwriting of a loan. That's a lot of the verification process, employment, assets. Now, one of the things we talked about early in class, which is around rate locks. Rates do change by the minute. Now, once you're under contract with the seller, then we're getting a little bit more strategic on what we're doing with the market. Just before tonight's class, one of our clients went under contract a couple of days ago. We're talking now strategically about how do we watch the markets. We're going to watch the jobs numbers that come out tomorrow because we want to obviously select the lowest interest rate we can for a buyer. But it is important to know that interest rates are changing every minute while the financial markets are open. As we move to step 5, we're now getting closer to the finish line. We've now completed your loan approval. Appraisal's probably back. Maybe have some action items on your side to work on, but pretty simple stuff. Throughout these different milestones, you are getting disclosures sent to you. We have the initial disclosures that go out after your follow-up consultation. Then you get another set of disclosures once we lock in your rate. And then finally at step 5, you're going to get your final closing disclosure, which essentially gives you a 3-day cooling off period before we get to the very final stage called closing the loan. Okay. And closing the loan is an in-person process. Everything up to that point is all electronic. But at the closing of the loan stage, you're going to be meeting with a public notary just to sign your final loan documents. That same day of signing, you will be wiring in your final funds that are due for the home purchase. Those monies will get all accounted for. We'll also wire in the loan funds, and then documents get recorded with the county recorder's office. They'll record a transfer of ownership document. We call that a grant deed. They also record a deed for your loan, and we'll get reported back that those things have been all recorded with that county recorder's office. And then once that all gets confirmed, then you're now the official owner of the home. And that's a huge day of celebration. Love to make the call to our prospective home buyers to say, hey, guess what? Now you're the actual homeowner. And really cool feeling for them. And of course, us to be able to help support them on that journey. That journey generally starts in a class just like this. And then it kind of goes into consultation, getting pre-approved, and then go finding that home. But our relationship doesn't stop there with our clients. We have an aftercare program designed to help support you that as you're kind of getting settled into your house, if rates are starting to go lower and it makes sense to refinance, we're going to have that conversation. We're going to have you enrolled in our rate watch system. You want to kind of manage your mortgage obligation with our HomeBot system to kind of see what your home equity is doing. And so HomeBot can really help you with that and just kind of staying constantly top of mind with you with some just annual financial check-ins. Okay, so that's kind of what it looks like in the home buying process. If you're thinking about getting started and want to know what that looks like for you, that might be a goal for 2026, and we're still early in the year. We're just rounding out the first quarter. We'd love to help you. If it's a 27 goal or beyond, hey, let's meet and figure it out too. We want to just be a partner for you in home ownership. This is what our process looks like to get started. So it's an online application. You upload documents, and then you use our scheduling system just to schedule a consultation that's convenient for you. Okay. If you have questions on tonight's class and you just want to meet to just talk through some different scenarios or maybe a credit scenario or just ask some questions about product, certainly get connected with us for an introductory call. We'd love to be able to help you out there as well too. Any resources that we can provide you with, we want to be there for you. And this is kind of the outline of what our consultation looks like. So very similar to what you've heard in tonight's class, a lot of the same talking points, but ultimately what we're trying to do is just design a plan for home ownership. And then I just want to point out our technology for you. You can start the process via mobile. We send push notifications via mobile. We really try to lean into technology as part of our team and how we support our clients, but doesn't replace the human touch of this massive like financial decision. So, we really want to be accessible for you, whether it's call, text, email, whatever you need to make sure that you feel comfort in this purchase. Part of our UCR alumni partnership includes obviously these classes that you're attending tonight, but we also discount our services as well too. And so we provide a $750 credit or discount in your closing costs. Of course, you have access to all these different resources that we provide to you. And we have other partnerships across the country. So if you have friends or family members that think might enjoy this content, they can certainly check out some of the upcoming classes on mortgageeducate.com. And of course, all the recorded classes, including this class tonight, will be up there as well too. All right. And finally, here's all my contact information. So if you want to reach out to me after tonight's class, feel free to reach out, and you can give me a call or text or email, whatever's good for you. And I do want to put our socials up here as well, because we do try to put a lot of important content on our socials that can support you on this journey. But we also love what our community says about us, whether that's on testimonials that we have up or in our Reddit communities that really celebrate what we're doing in our communities around home ownership. So just want to kind of pass that along to you guys. It's been my pleasure being a part of this class tonight. Hopefully you've enjoyed some of this information. You got a few things to take away. I know we haven't got a ton of questions tonight, but I'm sure you guys are all jotting down some important notes there. But I want to we have a few minutes left in our session, so I just want to open it up for any questions that you might have. And just as a footnote, Ken did put the link to the Dream for All information page. If you want to hop on that is available if you guys are interested, and that might be a product you want to take a look at. Again, that is a lottery-based program. So if you think you're eligible or just interested, probably doesn't hurt to just explore the lottery and see if you get selected. Maybe that accelerates your timeline for home ownership. Okay. Well, I think everybody's still there. So I appreciate everybody kind of staying till the very end of class. But again, any questions from our audience? Okay. All right. Well, I hope you guys have a wonderful rest of the week. Got one more day left on Friday. Enjoy your weekend. Look forward to hopefully connecting with all of you soon. Have a wonderful night.